Ladies and gentlemen, good afternoon. I'm Barry Eichengreen from the University of California at Berkeley. In the conference business, we call this slot immediately after lunch nap time. We will try to prove that name and that conventional wisdom wrong. No panel could be better suited to proving that conventional wisdom wrong. This is the proverbial panel that requires no introduction, so I will be brief. We have Christine Lagarde, who is now in her second term as Managing Director of the International Monetary Fund, and as everyone will know, Madame Lagarde served previously as Finance Minister in the French government and in a number of other positions. We have Jaime Caruana, apologies, General Manager of the BIS, a position that he has held since 2009. Jaime was previously Governor of the Bank of Spain and Director of the Capital Markets Department, also at the fund. Finally, last but not least, certainly, we have Mario Monti, who has held several positions as a member of the European Commission. He served as Prime Minister of Italy from 2011 to 2013, where I believe he was his own Minister of Economy and Finances. He's now Senator for life in the Italian Senate, and like me, he is a student of James Tobin. So I think the ground rules will be the same as this morning. Brief statements from the three panelists. I noted a few moments ago I have no enforcement power, but the panelists have all promised to be brief, and then we will have some discussion and questions and answers. The title of the panel is Passing the Hot Potato of Policy Interventions. So let me start by passing the hot potato to Madame Lagarde.
Well, thank you very much, Barry, for the hot potato passage, and I'll try to pass it on without dropping it to Jaime after that, who will no doubt will do the same with Mario. It's an honor and a privilege to be with the three of you on this panel, with the task to wake up the audience and make sure that none of you falls asleep, has a nap, and stimulate your questions and interest. So, congratulations to the Bundesbank. In absentia, here is Jens, and I wish him a very happy birthday and great continuation for the Bundesbank. And congratulations for the thought-provoking title of that hot potato. Anybody who has watched the Das perfekte Dinner, not to be confused with le dîner de something else in French, will know that it's a bit of a problematic game to play. Clearly, not all of you have seen the Das perfekte Dinner. It was put in my speech to solicit a bit of laughter. Anyway, in the policy world, it could have consequences. So what I would like to do, drawing on a sort of dual experience that I've had the privilege to have, both as finance minister in times of crisis and then as managing director of the IMF, is to sort of dance around very quickly, less than 7 minutes here, around 2 points. One is the importance of a comprehensive approach, and that's the whole point about playing volleyball rather than hot potato game. And the second is why, instead of that comprehensive game that happened on occasion, and I'll show that in a minute, but obviously you all have memories of that, why is it that the central bankers are often left holding the hot potatoes with nobody to pass it on to? So, as a first point, I would just like to observe that central bankers, a bit like the IMF actually, are typically first on the scene during a crisis. They are the typical financial fighters, and a bit like us, they are armed with generally a clear mandate. And there are no institutions better suited to restore confidence, kickstart frozen markets, and avoid a financial meltdown. During the last crisis, I could certainly see that firsthand in those sort of 6:30, 7 a.m. morning conference call that we had with the central bank and with a few other regulators around the table to make sure that liquidities were there, that banks were prepared to actually trust each other a little bit and accept to move money around. But even after that, central banks could still be counted on to support the recovery through unconventional monetary policy. Fortunately, despite those unconventional monetary policies, there was not much by way of who to pass the baton to, because structural reforms were lacking. And because on the fiscal front, a lot more could have been done, and not much was done. However, and I want to start with that, on occasions, there was a comprehensive approach. And we clearly saw examples of that comprehensive approach through good cooperation principles. Clearly, those of you who participated in those meetings remember that whether it was the G20 in Washington or subsequently the G20 in London, the policymakers and central bankers decided to join forces. The latter with arming themselves with a 2% stimulus package, which may have been a little bit too undiscriminated and not country-specific enough, but at least pushed growth up by 1 percentage point at the time, while by the same token, the central bank governors were doing what it took at the time in order to restore liquidity and fight for recovery. It's also clear, since that has happened, that banks are now in a much safer place, thanks to advances in financial regulation. And today, the IMF resources have been brought up to a little over $1 trillion to strengthen the global financial safety net, which in the meantime has also been enriched by a string of swap lines which exceeded by far the original swap lines that were much relied upon at the time of the height of the crisis. Similarly, cooperative approach, comprehensive approach, the euro area built up institutions that did not exist at the time, whether it was the European Stability Mechanism that succeeded the EFSF, the Single Supervisory Mechanism and Resolution Authority that joined the ECB, although with a different and separate mandate. And I'm sure that the euro area will be moving towards a strengthened and more comprehensive banking union that we have been calling for a long time, and which I know some are looking forward to. But despite all that, which were good developments, we could argue that this, in the main, has taken too long for the recovery to pick up quickly. And that in the meantime, because of reduced investment, because of accumulated unemployment, and some of it anchored into sort of long-term unemployment, the factors of productivity have been hampered. And it's hardly surprising to see that productivity has moved from an average of about 1% during the period preceding 2007 to 0.3% afterwards. But I'll come back to that. Actually, I can mention that now. That 0.3% is certainly partly attributable to that sort of slow recovery process that I will discuss in 1 minute. But there were pre-existing trends to that low productivity as well. It certainly was not helped by the weak investment and high unemployment. So that's really where I want to get to, having described a few of those incidents or occurrences of good, comprehensive and cooperative policies that attacked the issues from all angles, monetary, fiscal, less so structural reforms, but a bit of that. Why it is that eventually, in the main, central bankers were left with the hot potatoes and nobody to pass it on. What were the reasons for that? I would say, having been in the shoes of a finance minister for a little over 4 years, I would say that, first of all, the political process was certainly a hurdle. A blessing and a curse, attributable predominantly to the democratic process of many countries. And I remember a conversation with people in this room as to which government, which institutions, which constitution in each of those nations actually facilitated the process of moving fast and concluding that within the Eurogroup, for instance, or within the European Union, actually, probably 2 or 3 countries could move really fast, precipitated by a crisis situation. Not necessarily ignoring the democratic principles, but with the ability to actually harness the power to change things and take crisis measures. So the political process is a slowing process which discourages certainly fast decision-making processes. If you consider, I'm going to take on purpose an example outside the European Union, but if you consider the 2009 US stimulus package and the TARP approach to fixing the financial institutions and other institutions, certainly there was a trial and errors and going at it again. And I vividly remember, I'm sure Jean-Claude will remember as well, Hung Paulson, wanting to get that TARP across to Congress and passed, and failing first time around, and having to sort of go at it again throughout the process. Of course, a lot of value was lost, and it wasn't, his determination to lose that value. It was just the process by which it had to go through. Now, the question is really, how can the decision-making process be improved in a time of crisis, so that all policy levers can be used and not just monetary policy? And that brings me to the second reason, which I believe can explain the reason why the central bankers end up with that hot potato. They do so because they can act fast. And many in this room know how to deal with crisis. Many of you know how to think in terms of worst-case scenario, best-case scenario, cost analysis, benefit analysis, measuring the unpredictability and assessing the potential risks. The Bundesbank, of course, has experience in this, going back all the way to the Herstatt Bank. So does the BIS, actually, and I'm sure that as the banker of all central bankers, you must have sleepless nights weighing the worst-case scenario as opposed to the medium side or the baseline scenario. So you know how to do that, and please continue using those contingency plans because, everybody will continue counting on you to take decisive actions when needed. The problem is, how do we get other policymakers to process along those same analytical tools that you use, to think in terms of anticipating policy actions? How do we design frameworks that balance rules and discretionary power? The necessity to consult with parliamentarian authorities, with having to manage a situation of hot crisis. And how do they manage to weigh the benefit of the short-term expectations with the long or medium-term anchoring of expectations? Certainly my goal at the IMF, as you indicated, Barry, in this second term, is to help that effort in identifying best practices, helping peer-to-peer, sharing knowledge, and making available this intelligence that we get from the experience of crisis that we have accumulated over the years, using, to that effect, technologies that were not available a few years back. More to come on that front. And that takes me to my third point, which is knowledge. There was considerable skepticism about the counter-cyclical role of fiscal policy before the crisis. And clearly we have to draw knowledge from what we have gone through and possibly be prepared to reconsider or rethink our position. For example, we have found that fiscal multipliers are particularly large in severe downturn, particularly when the downturn is well scattered over territories, as was the case in the Eurozone, and when monetary policy is impaired by the zero lower bound. We certainly saw that very clearly back in 2012 when we reassessed some of our parameters. We're also seeing that fiscal policy can incentivize and complement structural reforms, an idea that I hope we can discuss further, and that needs to balance the short-term benefits of incentivizing and encouraging and facilitating the structural reform while anchoring at the same time into the medium term. So that will conclude my few sort of ideas and views about that question, those 2 points that I'm keen on. One is sometimes policymakers can have that comprehensive approach and cooperate with each other. When the crisis recedes, why is it that often the bankers are left with the hot potato? And what can actually incentivize, encourage, educate policymakers in order to also participate in that approach, which could leverage a lot more output than if central bankers are left on their own, holding it all together. So from hot potatoes, I would certainly much prefer that volleyball game where you have to keep the ball up in the air and you don't score if the ball falls in your camp. Thank you.
Good afternoon. It's a real pleasure to be part of this anniversary conference celebrating 60 years of Bundesbank contribution to stability, to credibility, and to independence. And I am very happy that I was invited to this conference. Again, the question that we have been asked is who is willing to act? And I think really there has been a lot of action, as Christine was describing first. However, I think that the action was unbalanced, and I think central banks certainly have done and have acted with unprecedented force and scope. But the responses were not even. There has been other parts, and Christine was mentioning reforms that have been lagging, and still, in my view, are lagging. I think that still today, the policies that address long-term weaknesses, long-term issues in our economies are still lagging. And this is what I would like to devote a little bit of reflection today. Yesterday there were 80,000 people running here in the streets. I think it is not the same to run sprints than to run a marathon. And I think we have seen from policy making a lot of sprints, but we are really running a marathon. And I agree that sometimes you have to run or you have to act as fast as you can. And as Jean-Claude mentioned, there are times when you see that the markets there is a risk of a meltdown. You need to run, you need to act. And I think the central banks did an excellent job in doing that. But we are running a marathon, and a marathon where we all should be part of it. It's not just central banks. And why we should take care about this marathon or about this long term? I tend to think that we pay a lot of attention to things that move fast, but we have not paid attention to phenomena that are slow-moving, that take a long time to develop, that perhaps do not change noticeably during a normal business cycle. And I am thinking of several examples, but there are plenty. Perhaps we are not paying enough attention to the buildup of financial imbalances, to the growth of balance sheets, the growth of balance sheet, the growth of public debt, the growth of private debt. And a lot of that has happened and has continued to happen. We have not paid enough attention to other trends, the slow growth of productivity. By the way, we have found that there is a connection between the growth of debt and cycles and property cycles and slow productivity growth. We need to pay attention to this interaction and more interactions between economies and between the financial sector and the real sector. We have not paid enough attention to all the implications of technological change and to income distribution, inequality. We pay attention to demographics. I am not sure that from the policy point of view we are paying all the attention that it is needed. Perhaps there is a bias in the way we look at things, a bias that perhaps needs to be studied. We pay more attention to fast-moving and we don't pay enough attention to slow-moving phenomena. The problem is that these facts may be slow-moving, but their effect is cumulative. And at some point of time, this cumulative effect becomes unsustainable, and then the consequences start to move quite fast. And of course, the temptation then, when things move fast, is we need a quick fix. And again, it's another sprint, but we are not doing the marathon that we should be doing. The tendency to focus on shorter horizon is perhaps a fact of modern life, but I think behind this there are a number of forces that we need to analyze. First, perhaps a conceptual framework that we use that tends to pay more attention to the business cycle horizon. And just thinking of monetary policy and thinking of the frontiers of central banking, and that links with some of the discussions that was in the very good panel that we had this morning. We from the BIS, we think that the monetary stability and financial stability are two sides of the same coin. However, the time horizon for these two elements is different. Financial stability has to be analyzed in a much longer time span. And that means that if they are together, we need to think of financial stability and monetary stability together and with a longer time horizon. If the monetary policy is focused narrowly on inflation stabilization over the business cycle, we may run the risk of neglecting the building up of some of these imbalances, the building up of some of the stock of debt over the financial cycle. And again, over the extension of finance and these property booms are usually associated with misallocation of resources and therefore associated with lower productivity gains. And we have analyzed that, and this is not new that there are misallocation of resources, but frankly speaking, when we analyze that, the numbers that come out are significant. So part of the productivity slowdown could be explained by this kind of phenomenon, and this requires a little bit of more attention and more analysis. So this was the first thing that I wanted to say in terms of focus of shorter time horizons. First is a conceptual framework that perhaps is not paying attention to the long term. Second, obviously we are pressed by markets. Financial markets have very, very short periods of time. And it may be milliseconds for trading, it may be months for some reporting or quarterly reporting of benefit of profits, but this is very short term, and we are pressed by that. And third, and it has been mentioned in the previous exposition, it was political cycles. Political cycles do not generate the kind of incentives that help to take long-term decisions that have long-term payoffs. Now, probably some people is saying I'm oversimplifying. Yes, I am oversimplifying. There has been examples of reforms that have been taken, of policies that have been looking forward-looking and with long distance, long time horizons. I would mention that certainly all the regulatory agenda in the financial sector has been thinking in the long term. Some of the institutional reforms in Europe are forward-looking and looking ahead of time. So all these are positive and also at reforms at national level. But I would say that it is fair to say that the main gap in this balance of policies has been in policies that address the long-term issues. And the risk of relying too much on policy sprinting is that we could exhaust policy room for maneuver over time. And I think we have to think that we will have to, sooner or later, we will have to face just a usual downturn. I am not thinking of a crisis, etc. We will need to face this kind of downturn, and it will not be that easy. And we will need to face still a process of normalization, a positive process of normalization that still will have some challenges ahead of us. So what is the potential way of getting out of it? And I think I've almost consumed all my time. I said 7 minutes, but it's a Spanish 7 minutes, not Swiss 7 minutes. So I will use 1 minute more. So how to get out of this? I would say that first, it will build economic resilience. And I think this was a very good theme of the German G20. It will be not forgetting the benefits of what we have achieved in the past, and that I mean globalization, etc. And the third element that I would add is I think there are good news, because I think some of the headwinds that we have had in the past are starting to be tailwinds. And I think this is the right time to use these tailwinds to get a little bit of space in policies, and also to take reforms, and to take reforms in perhaps a less painful way in the future. So I think we have a gap, but this is the right time to start thinking that there are some tailwinds that we are not sure how sustainable are going to be, all the momentum that is being gained by the global economy. But certainly, if we improve resilience and we gain some capacity to act in the next downturn, I think we will be contributing to make it more sustainable. And there are plenty of examples of how to do that that we could discuss, from completing the new regulations to making the economies more adaptable to changes coming from technology, changes coming from globalization, making them better able to reallocate resources, etc. But again, I think I exceeded my time, and we can discuss that over the discussion. So thank you very much for inviting me.
I first met the Deutsche Bundesbank when she was 15, and I was already 29. The place of the encounter was rather romantic, although plagued with mosquitoes in those long summer evenings on Bodensee. The occasion was the third Constance Conference on Monetary Theory and Policy, organized in June 1972 by Karl Brunner and Alan Meltzer. It was there that I first heard the views of Horst Bockelmann from the Deutsche Bundesbank and of Ernst Balzensberger from the Swiss National Bank. I was coming there after having been exposed, like Barry, who made much more profit out of those teachings academically, to the deeply influential teaching of James Tobin at Yale. And I was an avid reader of the rather sophisticated analysis of the Banca d'Italia. Listening to Bockelmann, I was shocked by the much greater simplicity of the Bundesbank analysis, which was then preparing for its publicly announced quantitative monetary targets, which would have been introduced in December 1974 for the first time. The analytical scheme of the Bundesbank seemed slightly naive, but I was impressed by how well, precisely because of its simplicity, it would help forge a strong alliance between a central bank and an inflation-averse public opinion. You cannot speak to the public opinion to get its support if you're too sophisticated. So I must say that combination of Alpine, German, Swiss, well-meant, almost naivete to a fundamental economic relationship like the one between inflation and monetary policy was very attractive. That simple link prompted me to study piece after piece the whole model, of which the objective of price stability and the independence of the central bank were only two components. So the affair that started in those evenings on the lake saw the Latin boy capitulate to the seductive charm of the soziale Marktwirtschaft, to say nothing of Ordoliberalismus. It was there, I am afraid, that I began my genetic modification into, I quote, the most German among Italian economists, end of quote, which I always took as a compliment, even though maybe in some cases it was not meant to be a compliment. Then the circumstances of life led me to be, on a few occasions, considerably more German than the Germans. And that gave me particular pleasure, for example, when I could exercise that newly found virtue for an Italian at strokes of Anstaltlast und Gewehrträgerhaftung in order to bring to market discipline the Landesbanken and the Sparkassen. Now, more seriously, but that was pretty serious as well, some of you may remember, I was, in the subsequent years, absolutely full of admiration vis-à-vis Ottmar Issing for transplanting the mind and heart of the Bundesbank. Yes, because central banks may on occasions even have a heart into the ECB. And I was particularly admirative of what Jean-Claude Trichet was able to do in normal, but then in highly turbulent times. And we owe profound gratitude to personalities like these. Now that I've done my outing, I feel more comfortable in devoting the few remaining seconds to a few observations on the relationship between political decisions by governments and central bank independence in a way which may seem falling slightly short of pure German orthodoxy here, but now I can afford. I will use experiences that, having been a student of monetary theory and policy who never became a central banker, unlike most people of quality, but then had an opportunity to see central banks from a political position, temporary. I was interested in a couple of examples that I want to report to you. Because I thought that on occasions, the political decisions by governments may enhance central banks' independence, or at least make the concrete exercise of independence more easy. As soon as I was asked to become Prime Minister of Italy in November 2011, I was invited to a meeting in Strasbourg by the French President and the German Chancellor. It was the first meeting. We didn't have much time to spend in cordialities, given the financial situation in particular of Italy. On the other hand, I couldn't do much else than reminding in the press conference the joint hosts that it was no country in Southern Europe which originally put the credibility of the Stability and Growth Pact at big risk, but it was the countries who surrounded me in the press conference. But then during the meeting there, one little but important thing was achieved that I would pompously call the doctrine of symmetrical silence. For many months, and a few years in fact, there were constantly a French president putting pressure verbally on the ECB for the decline of interest rates, some German minister equally, but in the other direction. I think Jean-Claude Trichet, who is so indifferent to these things, luckily for us all, who maybe not even noticed, but I'm sure you that those pressures were there. And we simply stipulated a common sense, the three of us, arguing that maybe all political leaders should not speak, neither to criticize increases nor to criticize decreases of interest rates. This in itself, I believe, helped the ECB to feel more independent. Then, in the midst of the crisis, a few months later, we collectively, the heads of governments of the euro area, I think, and I must say at all stages with the high moral and technical accompaniment by an authority who now sits in the central position among the three personalities here, we felt the pressure to induce the ECB to do more than it was doing in terms of, first of all, safeguarding the integrity of the euro, which was at risk, and secondly, to avoid the frustration that countries who tried hard to follow all EU recommendations were feeling because they didn't see their interest rates coming down in the markets. And we came to a unanimous agreement, the heads of states and governments of the Eurozone, after a long night of negotiation, only tempered in gravity by a Germany-Italy football semi-final for the European Championship, which did not add joy to the outcome of that night to one of the two countries. These are very serious matters, as you know, in spite of my light treatment of them. And so we after months of negotiation, I believe we brought to the table something that couldn't have been more German than it was. Why? Because the heads of governments, with anodyne and dull statements, said that it would have been imaginable and acceptable to see stabilization rates on government bonds. Can you imagine what anathema this was until that moment? But only for countries who followed all EU recommendations. So, translated, for the virtuous countries. No surprise that after that statement at the end of June, just a few weeks later, the president of the ECB felt more comfortable in making use of the independence of the ECB, making in London a strong pronouncement which had a profound impact on the markets. After that statement, he could be sure that no signatory, so no heads of government in the Eurozone could object. And then, with great ability, that was translated into a monetary instrument, the OMT, that Jean-Claude Trichet this morning qualified, I quote, never used but very important. And that, we know, did help a lot in stabilizing the markets. I will conclude by saying, perhaps in that never used, there is a limit of an excessive short-termism in German purity. Christine mentioned short-termism. This is a great concern for all of us and for central banks. Germany, I think, is the least short-termist country in the world, at least in Europe, given its culture. But because it has a model, which is an economic and moral model in its mind, it attributes more importance than most to not having an even short-term, temporary deviation from its principles, which leads it, on occasions, not to accept slightly more pragmatic solutions, which in the longer term may serve the very rigid purposes of the German model better. For example, I know the anxieties, which I must say I share, for a flood-known QE that was probably necessary, but that has overtaken a lot of territory, throwing materials that, in terms of quality of assets, one might never have initially thought to be consistent with a central bank on its asset side. But why was the OMT never used? Because after the remarkable flexibility shown by the Chancellor on that night in Brussels, she, but particularly her finance minister, felt it necessary at the stage of specifying the concrete articulation of the instrument to make it clear that a troika would have been needed if a country did apply for OMT. We are all delighted to have troikas also because that brings the mark of Christine Lagarde from distance, but still, for some reason, countries do not really like very much to submit themselves to that procedure, particularly for countries that, if they can apply to OMT, by definition, they are virtuous countries. Would it not have been preferable to have a full usability of that instrument, which might have, I believe, contained the excesses of QE very much, and would have made the recipients of central bank liquidity more selected on the basis of virtue? If I were a German, I would have been happier had this been the case. So I think that, being an Italian, I have somewhat exceeded my time, and so I stop. Thank you very much.
Thank you to all three panelists for provocative remarks and giving us a very rich intellectual menu. I have been sitting here and jotting down a long list of questions that time does not permit me to ask. Perhaps the role of the moderator is to identify a common theme. If I see a common theme in the three sets of remarks, it has to do with the boundaries of central banking. What should central banks worry about? Clearly, they should worry about inflation, but we are here being hosted by the Bundesbank. We talked about that this morning. Should we add financial stability to that list? Fiscal policy, structural reform, inequality. All of those topics came up in the remarks that we just heard in connection with central banking. So let me ask the panelists about a couple of those in turn, starting with financial stability. One popular interpretation of the great financial crisis, the global financial crisis, is that it was encouraged by the great moderation in the preceding period that led to more risk-taking than would have occurred otherwise. Now we are in a period, as we heard briefly this morning, where standard measures of volatility are, again, at exceptionally low levels. So why is this? Does it mean that risks are absent? If not, how do we understand it? And how should central banks be reacting to it? We know as well from the experience of 2006, 2007, that crises tend to happen in the wake of interest rate normalization episodes. And the markets tell us we're about to have another step in the direction of interest rate normalization approximately 5 hours from now. So should we be worried about that? How pressing do you regard these financial stability risks? How should central banks be viewing them and reacting to them? We might proceed in the same order as the opening remarks or otherwise.
Okay. And we try to be brief and to your point. Okay. So do I worry about what Janet Yellen is going to decide in a few hours' time? No. I'm with market on that. 95% certain of what is likely to happen. Good sign. It clearly indicates that unemployment has reduced significantly. Inflation is getting close to where it should be, and not just inflation, but core inflation as well. So those are good indicators of an economy that is doing better, largest in the world, hopefully with good spillover effects in other corners of the world. What I worry more about is the combination of that aspect, which is good, combination of that with asset valuation, which is probably pushed by a degree of exuberance that is difficult to explain at this point in time, and proposed financial regulation modifications, which, if generalized to the entire banking sector in a country like the United States, would be a cause for worry. I think we are at a stage where financial regulations have made significant progress, where a little more is yet to be developed in terms of counterparties on CCPs in particular, where the banking resolution frameworks have to be better fine-tuned and completed. And we're clearly some streamlining, some lowering of the bar is acceptable for small cooperative banks, but we're going way beyond that would be a factor of concern and a cause for concern combined with the other two.
Thank you. Starting from a more theoretical analysis of what central banks should do or should do not, I think that the starting point would be to say that financial stability has never been properly integrated in the frameworks of monetary policy. And this is something that we need to work more. Progress has been made after the crisis, and now you can see much more analysis. And also you can see now that macroprudential policies have taken a much more prominent role. There is an element of discussion on to what extent macroprudential policies completely isolate monetary policy from financial stability. And on that, my view, and that was part of the discussion this morning, on that, my view, it would be that it would be very nice if that was the case. It would be very elegant if that would be the case. That would be very consistent with the models if that would be the case, but I don't think that is the case. I think monetary policy has to take care of financial stability. We still are discussing how, but I don't think that macroprudential can just relieve monetary policy from the obligation of continuously monitoring what happens. And the explanation is that both monetary stability and financial stability at both sides of a same element. So I don't believe in this separation principle, and I think this is something that, again, more work will need to be done. The work that we have been doing indicates that perhaps part of the solution would be that monetary policy should be reflecting financial stability indicators in a continuous basis and in a consistent basis, not necessarily just when the problem has emerged. And it seems that if you do that, you get better results in terms of the normal objectives of monetary policy, and you get some analysis of what would be the interest rate equilibrium that is higher than the normal analysis. But that's an hypothesis that needs a lot of work and that. Now, on the present situation in terms of risks, financial stability risks, I agree there are some issues on asset valuation that have been pushed, in addition by a significant growth of debt. And I think that is the combination. If you combine this with asset valuations, with debt, and with low productivity trend, that's not the best of the worlds. And I think this is and we need to act in different areas. At the same time, there are credit cycles that in some countries, mostly those countries that were not affected or significantly affected during the crisis, where they have had some credit cycles, and that is turning. That's another point of that we need to pay attention. And there is the interest rate snapback risk that could happen, which would be related to just normalization of some of the term premium. So there are a number of issues that we need to pay attention, and this may materialize in some strains, or it may materialize just in more headwinds for growth. So it's difficult to know how this will, but I think these are areas of financial stability where we all have to pay attention. And again, building resilience, which was my theme to some extent, is the way to go. It's not just fine-tuning, it's building resilience.
I would add two very quick points. One reason of concern about financial instability to me is the lack of selectivity. It used to be the lack of selectivity by the markets after the inception of the euro. Now I'm afraid it is a lack of selectivity of what has largely replaced the markets in terms of financing governments, that is the monetary accommodation, as I said earlier, not done really on on the basis of incentive to conduct prudent fiscal policy. And now this happens at a time when I think we should all admit that the credibility of the instrument to enforce a prudent fiscal policy, i.e. the credibility and the Stability and Growth Pact, is believed only by those who really want to believe in it. And my second point is about financial instability. I'm the least well-positioned here to assess one factor which I feel nevertheless will be important, namely the disconnect in what used to be in the last several years a well-coordinated effort globally to towards a more joined-up financial regulation, etc. The rather standalone position of the new US administration and its tendencies in terms of revisiting certain domestic regulations, how will that impact on the global governance as financial stability is concerned?
Barry, I just want to add one thing to a really interesting point that Mario made in his presentation. When you talked about the way in which political authorities can reinforce and enhance the independence of the central bank. And you are completely true. I think the opposite is equally true. And regrettably, including in the European Union, and certainly beyond, and in some of the emerging or developing countries, we're seeing it. And I can't help thinking of them. Political interference can actually weaken the independence of central bank. And while most of us, have reasonably stable positions that you have to defend and that can be enhanced by political decisions, some of you have seen very traumatic moments, and have lived those traumatic moments where political interference actually hurt independence and sometimes damaged central bankers themselves. So I think we need to have them in mind as well, and how it can work both ways. It's precious.
Let me follow up on that, and maybe by turning the question around a little bit. Should central banks worry about fiscal policy? And if they worry about it, what should they do about it? Does the separation principle that does not apply in the domain of monetary policy versus financial policy apply in the domain of monetary policy versus fiscal policy? Should central banks comment on fiscal policy? Should they reprimand the fiscal authorities when the latter are being irresponsible? Will this strengthen central bank independence, or will it potentially rebound in an unfavorable way?
Whether central banks should or should not comment on fiscal policy is a very interesting but theoretical question, because at any rate they do, and they do a lot. And I believe that it is, after all, appropriate, but even more appropriate than commenting towards fiscal discipline, coming from a country where, following the example of the German Bundesbank, it took a lot of time to disentangle fiscal policy from monetary policy and to put in place what was called the divorce between the Treasury and the Bank of Italy. I must say that I would not be enthusiastic of seeing the union that was cut in Rome many years ago to be permanently reconstituted in Frankfurt.
I would remind Mario that, after all, economics is the science of establishing that what works in practice also works in theory. Inequality, we've had discussion of that as well. One question that occurred to me both this morning when the issue came up and this afternoon is why the inequality problem fell off the radar screen of the international policy community to the extent it did before the political reaction. Should central banks take this inequality problem into account? Should they worry about the impact of unconventional monetary policies on the rentier?
Okay, that's a very difficult question. That's the hot potato that you were referring to. I would tend to think that, first of all, of course, the central bank have to pay attention to these things, and I express the view that probably we have not paid enough attention in the past to this kind of phenomena. I think that there has been some discussion about that, and I agree that, yes, the actions of the central banks can have distributional impact. I also tend to agree with the view that was expressed this morning that if we are concentrating on the normal action of central banks through a business cycle, and it's not a very, very long kind of tendency on their actions, I think normally the effect is positive, and the effect is positive basically because one of the most inequality issues is unemployment, and to the extent that they help during a cycle to help on this front, this is one good contribution that central banks have to do. I'm more concerned when the actions are taken for a very, very long time and low for a very long time, things that go beyond what is the normal cycle. That sometimes implies that maybe that you are trying to smooth, because you cannot solve, but you are trying to smooth the lack of action of other policymakers. And then I am more concerned about that, because it has distributional effects that may have some implications, and you are extending because you think that you need to smooth something that perhaps is reflecting what it is missing, and what it is missing is not what the central bank should be doing, what others should be doing. So I think in that area you start to be in a very, very difficult, in very, very difficult terrain. But I think if things are more on a normal cycle, I think central banks do have to care, but normally what they do is a positive contribution in the sense that they contribute to the economy to work better.
I would completely agree with Jaime that if there is any area where the point is clear that there has to be cooperation, it's that one. Certainly at the IMF, we were able to really document and analyze the macro criticality of inequality in general. And, to the extent that excessive inequalities have a bearing on growth, have a bearing on sustainable growth in particular, clearly the issue of inequality has to be on the mind of fiscal policymakers. And those fiscal policymakers who hold other levers than central bank governors do have to cooperate with central bank governors in identifying what impact the tools that you are using, and I'm turning to you as if you were central bank governor of all central bank governors of the world. So what you are doing, what impact it has in relation to inequality. I certainly for myself think that we have not paid enough attention or early on to these issues of inequalities, just as we are currently not paying enough attention to growth on a per capita basis. And we are still guilty, and this might be us, but I think it's more generally shared, we're still paying too much attention to macro numbers and not enough to the sort of micro impact that it has on people's living and survival sometimes.
Nothing to add, really.
The last item on my list of boundaries for central banks is structural reform. Jaime emphasized the importance of structural reform, but I can be blunt. What does that have to do with central banking, to start? How can central banks encourage structural reform? Do they have to worry that monetary accommodation will delay structural reform? And there's a corollary here for Christine and the fund about what the fund has learned about structural reform from the crisis. The IMF has repeatedly tried to streamline its structural conditionality. How is that going?
One thing that we certainly learned from the crisis is that fiscal policies and structural reforms have to walk hand in hand, and that a degree of fiscal accommodating in the short term can be extremely helpful to facilitate the implementation of otherwise difficult structural reforms. When you restructure the labor market, for instance, it can be, and it is demonstrated, that it is helpful to have a little bit of fiscal stimulus exercised by way of tax policy or otherwise. So that's learning number one. Number two, the relationship with the second learning is that not all structural reforms are the same. And some of them have a short-term impact and bearing, others have a much more medium and longer-term impact. And the question of which ones to implement first, how to calibrate them, how to have that combined with the fiscal policy that I was referring to earlier on, depending on how much slack there is in the economy and what is the level of indebtedness of that country, all of that matters. The link with central bank policies and monetary policy, I think, is fairly simple. The idea behind the structural reforms is to improve the productivity, improve the ability of household and corporates to actually grow, invest, create jobs. And if that happens, clearly those enterprises and the households are less of a burden on the balance sheets of banks, which themselves are better transmission channels when it comes to transmitting the monetary policies that is developed by central banks. So I think it all comes together, which is why we talk about the trinity of measures or the three-pronged approach, depending on how technical we want to be.
Yeah, I think obviously central banks are not the ones that have to perform structural reforms. That's clear. Second point is that I would like to enlarge a little bit this point. Is not just structural reforms, it's repair and reforms. And by repair, I think it's repair balance sheets. And I think there the central banks can help a little bit more. But I tend to think that the most important link is the other direction, is that if we would have if we would have had more of these repair and reforms early on the cycle, probably we would be in a much better condition to normalize rates, which I think is what would be also help the economy. And I remember at the beginning of the crisis that we were saying, okay, well, reforms, it may take 2 years, 3 years to have effects, so let's postpone, let's wait for a better time. Okay, it has already been 10 years. I mean, how many cycles of that we would have done? And it is very difficult. I think this is not absolutely easy, and I think it's a little bit too easy to say that. But I think that these reforms and this repair, and it's not just authorities, it's also financial institutions that have to repair their balance sheet. So I wanted to open up a little bit. This is repair and reforms. And doing this earlier, it helps enormously to get through this very complicated period of time that comes after this kind of crisis. And the experience of the Nordic countries, etc., indicates that it's better to do it earlier than not to postpone these things. So I think it's very important for monetary policy, but I think it would have made the life of central banks much, much easier. And therefore, for the economy, much better.
I was going to say just that we should not neglect structural reforms in the banking and financial sector, but Jaime did it.
I should open things up to the audience, and I will do so in a moment, but I cannot resist a final question about international cooperation in general and in response to the next crisis, whenever it occurs. We have three important perspectives here, that of the fund, that of the BIS, that of Europe. Do you think, respectively, that we're in a better position to mount a cooperative response next time? On the one hand, we have swap lines and facilities that we didn't have before the last crisis. On the other hand, we have what Mario cosmetically referred to as a new administration in Washington, D.C. How should we think about the scope for cooperation the next time?
Can
I've set each of you up.
Can I open up by saying essentially nothing? Namely, would we not have this time round the additional difficulty of having different views of the world on both sides of the Atlantic? That was not the case, I think, on the previous occasion, or was it?
If you're talking, and picking up on Mario's point, if you're talking about international cooperation in times of crisis, if we've learned something in 2008, 2009, is that those crises ignore boundaries, they ignore political affiliation, they ignore administration, they just swipe through. And I think at that point in time, there just has to be international cooperation. And it is bound to be in the vested interest of each and every country to actually cooperate and rally around what needs to be done. I believe the central bank governors cooperation that we saw at play in 2008, from September 13th onwards, and actually the year before as well, would occur yet again. I believe the G20 is sufficiently rehearsed now to be able to also regroup and face the crisis. What I'm more concerned about is whether or not that international cooperation that actually would be displayed because of the crisis is actually also focused and displayed in times of non-crisis, when prevention is needed, when alert systems have to be in place, where crisis management has to be rehearsed, where stress testing the system is needed, where harmonization of regulation is much needed, and when there is still the same creativity and inventiveness in the financial world to circumvent some of those regulatory environments. And, you know, clearly technologies are either going to help or hinder that process.
And Jaime, financial cooperation, agreement across the Atlantic?
Well, we try to summarize at the BIS our views on cooperation, international cooperation, by saying that it is very important to have your house in order, but you need also to contribute to have the neighborhood in order. So we need to contribute. It's the only way to have stability. If you do first your own house in order, but then you do the contribution to the neighborhood in order. And therefore, the spillovers and the spillbacks are so important, so big. I think this is the other thing that we underestimate. We underestimate financial aspects and we underestimate spillovers. And we need to have a much better understanding of how these spillovers work in order to internalize this into the decision policy making. And this is very difficult, and I know it's not very popular either, but particularly for the large central banks, even in we say it's a kind of enlightened way of looking at your own interests, because what you do will influence the global conditions, and the global conditions will spill back to you, and at least you should take into consideration this kind of elements, and we have seen this working. So we are very much in favor of cooperation. Jean-Claude this morning said it very well. We have among central banks significant amount of cooperation, but he ended up saying, but we probably could do more. I think we could do more in this sense, in the sense of internalizing better how the spillovers work and trying to make it more internal. I am not thinking that there should be a decision-making in one kind of body somewhere. That's not the kind of things that I think. Now, in terms of the interatlantic, at least I would like to say one thing on the financial issues. And there is some discussion about this Basel finalization of the Basel Accord. I think a lot of work has been done, and I think the positions are close. So I think that despite all what it is said, the cooperation continues, and I think some of the concerns are more related to how they will, for example, United States deal with their own regulation. But as far as the minimum regulation that is set in Basel, I think the cooperation, as far as I see, has continued, and I have seen good cooperation spirit, even if it is true that it has not been concluded, and until it is not concluded, nothing is agreed.
Barry, can I just add that we should not think only in terms of the Atlantic Ocean. We need to think about the Pacific as well, because we certainly learned in the last 3 years that the source of disruption is going to be in multiple places, not just in the traditional source of origin.
Point taken. So we have a few minutes for questions from the audience. I would encourage people who ask questions to actually ask questions, to identify themselves, and if the question is directed at a particular member of the panel, to let us know that as well. So the floor is open. I see a hand way in the back with a white sleeve. Yes. Hi,
this is Harris Dallas from the University of Bern. So if I asked the panelists which would be the biggest threats to global economic performance over the next half a dozen, 10 years. Could they come up with a list of a couple of such possible threats?
Can you speak up a little bit?
Oh, you didn't hear me?
Yeah.
Okay, to repeat, I would like to ask the panelists to identify 2 or 3 of the most important threats to global economic performance over the next 6 to 10 years.
Let's take 1 or 2 more, and we'll let the panelists compose themselves, and then they can answer. Yes.
Yeah, Klaus Wiener. I have a question on financial stability, and I would like to know how concerned the panelists that central banks may be doing too little too late. Because to me, the biggest risk to financial stability at this point in time would be not that key rates rise suddenly, but that long-term yields would rise suddenly.
Yeah. And is there one more before we go back to the panel? So why don't we then turn back to the panel for the moment? Major risks and long-term rates. Are these separate questions? Mario?
Go ahead. No, go ahead.
A cyber mess, a cyber confusion, and a possible disintegration of countries or of unions of countries. Now, conjuncturally, this seems to be a less likely event now than it was 3 or 6 months ago, but because we have spoken of inequalities and other things, I think the factors for potential disintegration, which would have also huge implications in terms of less effective multilateral governance, could be large.
Yep, I think 2 groups of risks. One would be the financial risk. I will talk about them. I mentioned before. The second one would be more macro, and it would be that the global economy that is now growing in a consumer-led kind of pattern do not move to a more investment-led pattern. And this is something that it has been difficult, but we know that consumption-led growth is more temporary, and we need to find ways to make this to move more into investment-led growth or more balanced growth. On the financial risks, I mentioned the snapback risk. That was exactly what the question was referring to, the fact that long-term rates could move rapidly. That is difficult to calculate, to advance, but taking into account that from our perspective, each central bank will have to normalize at their own speed and their own moment, etc., but there has been some starting of normalization in United States. I think it is important to think that this process is a positive process, is a process that is reinforcing the positive momentum of the economy, but that there has uncertainties in terms of how markets are going to react. Markets have been too dependent on central banks, and this is not easy. So the way we try to characterize that is to say it has to be gradual, but it has to be steady. And if there is volatility, this should not be an excuse to stop the steady path of normalization. I think this is the way we look at this kind of thing, and it is a challenge that we have ahead of us, which is all the normalization process that, again, is positive, and each one will do it when time comes. But the markets have been for a long time depending on central banks, and we have significant uncertainties. We are in an uncertain world. With all this uncertainty, with all this debt, which makes everybody more sensitive to interest rates, we should expect some bumpy road ahead of us, and we should be preparing for that, at least as a prudent approach.
No, I would identify two challenges. One that is clearly the challenge of cybersecurity, which in a way is related to the second one, which would be our lack of anticipation of the acceleration of combined technological breakthrough. And I know this is a bit of a mouthful, but it's, you know, if you combine some of the breakthrough that we are seeing at the moment, they accelerate. They are conducive to massive disruption on the job markets, disruption of the supply chains that have been installed across the world, helping with the emergence of economies in developing areas, in emerging countries. That could be a major disruption going forward, which, if not anticipated, could just fuel more populism, more frustration, and more geopolitical risks that we are seeing in the short term.
I think we have time for one more quick round. I would encourage the audience. This is a once-in-a-lifetime opportunity to ask anything you want of this exceptional panel. Ignore the fact that you're being filmed and ask away. Jürgen Stark.
Jürgen Stark, a question to the most German Italian economist and former Italian Prime Minister. You referred to OMT and, in your view, the success of OMT. To what extent has OMT delayed structural reforms, and in particular in the Italian case, has delayed the restructuring of the Italian banking system and the repair of banks' balance sheets?
I said that OMT was not used, not a euro was given through OMT. At the same time, I think in line with what Jean-Claude said this morning, the existence of OMT provided a safety net. You may have noticed that I said that, in my view, what in terms of generation of liquidity has compensated for the lack of activation of OMT, that is unconventional monetary policy and QE, has been of lower quality from my point of view, particularly from the point of view of conveying the right incentives to the system, than an OMT might have been. I don't know whether I'm clear enough. So OMT would have come with conditionality. The inherent conditionality that only countries in line with all EU recommendations might apply. Then there was a willingness to be ultra safe and to put on top of that the institutional conditionality of the Troika, which made the OMT totally unpalatable. So it was not used. I think it would have been preferable to erogate liquidity more on the basis of OMT, which would have let liquidity flow mainly or exclusively to the virtuous countries, rather than having the fallback of an undiscriminated QE. About the current unconventional monetary policy and QE, which I think was necessary at a certain moment, also because of the unwillingness to make of OMT a usable instrument. I think, yes, what probably is an excessive and prolonged creation of liquidity, I express myself in very classical and obsolete terms, does reduce the incentives. You delicately pick up the Italian case. I would certainly subscribe to that as well. And I believe that there are more countries in the European Union, and including in the Eurozone, and some of them would also need, for example, structural reform in the services sector in order to improve also their contribution to the rest of the Eurozone.
Coffee awaits immediately outside, but Christine wants the floor for 30 seconds before we
because
conclude.
I think we've been challenged by Mario. And given that Jens is back, I wanted to wish the bank a very happy birthday. There's a point in time when you start counting backwards. So as a result of that, I'm very happy to see that Mario is 46. Thank you.
Thank you to one and all.